Hi, I'm Piotr from Empirica. Today we are in our Wrocław office, and I would like to invite you to our kitchen, which is my favorite place here. As I'm gonna answer some basic questions about crypto market making, which is our work. Crypto market making generally is a way to improve the liquidity of your token. So token projects need market making to prepare for organic growth. So if you are a token project, you need market making to make sure that whenever your investors want to buy or sell your token, they will have a counterparty to trade with. And market making also allows you to decrease volatility, which discourages investors from trading your token. Market maker is a very important partner for each token project. It's a key relationship. So choose one that you can trust and choose one that will treat your project seriously. Choose one that focuses on improving the liquidity of your token by maintaining deep order books, narrow spreads, and assuring high uptime. If someone promises you only high volumes and price creation, run away. Why? Because these factors should be a result of a healthy project growth and deep liquidity. Okay, so what happens if there is no market maker? It's a lack of buy or sell orders on your books or in the pool on a decentralized exchange, which will lead to unmet supply and demand. And when there is no market maker, the spreads on your token are wide, which makes transaction more costly for investors. And price volatility may be high. And last but not least, markets without a market maker are easier to manipulate. So one of the first questions I hear from token projects is, what is the cost of market making? Basically, there are two cooperation models that market makers use. It's either a retainer model, which means monthly fees, or it's a loan with a call option. So what is a loan model with a call option? In a loan with a call option, market maker borrows tokens from your project. The loan is fully utilized for the inventory for liquidity provision. Find a market maker that will efficiently utilize the loan. Let's have a look at the positive impact of market making. In the upper chart, you can see how we increase liquidity in one of the markets. Green and red bars represent the liquidity depth we added to the bid and ask side within 2%. The big yellow arrow shows the start of our activity. Now, in the chart below, you can see how liquidity depth added to that market immediately influenced the increase of organic trading. Let's have a look how we can decrease the volatility in the markets. What can you see in that chart? Before our algorithms entered the market, price volatility was as high as 150%. After we entered the market, increasing the liquidity depth, take a look at the yellow arrow, the price got stabilized with a maximum volatility of 9%. One of the most important things for your treasury is effective use of capital dedicated for liquidity management. In case you lend assets to your liquidity providers, you should be checking how they use the token loan. One of the metrics is how the working capital translates to organic volumes. For a healthy project, monthly organic volumes should be a multiplication of the loan assets, as you can see in that chart. Assets you lend should work hard. That particular chart depicts a real situation from one of our clients. In just 2 months, the loaned capital generated 15 times more organic volume. Okay, so as the end of today's recording, I'll make myself coffee and I'll tell you something super important. And if you want to know more, just give me a call.